This is the beginning of part 2 of our module on trading and macroeconomic indicators, which discusses the principal macroeconomic indicators affecting the performance of various asset classes, including fixed income, foreign exchange, equities, and commodities. We remind you that part 2 of this module contains chapters 3 and 4, with chapter 3 examining monetary policy and its impact on financial markets, and chapter 4 containing the quiz. This chapter 3 examines the principal tools of monetary policy and its impact on financial markets. We begin with an examination of perhaps the most important driver of financial markets: monetary policy. Monetary policy is generally conducted through the control of short-term interest rates. Money and interest rates affect all macroeconomic variables, from consumption and investment to exchange rates and inflation. Monetary policy affects and is affected by the business cycle. Monetary policy officials react to perceived changes in the economy by adjusting short-term interest rates. They track changes in the economy through the different economic indicators described in the previous chapters, analyze the information transmitted through these indicators, and draw conclusions regarding the actions needed to assure a well-functioning economy, defined typically as sustainable economic growth with price stability. The decisions of the policymakers are difficult to predict for most market professionals, and often result in large price movements across a number of asset classes. Traders seek to interpret correctly the economic indicators released most recently in order to anticipate policymaker reactions in the form of short-term interest rate adjustments and other intervention tools. This task is extremely challenging, as economic indicators often contradict each other and push the market in different directions. But a solid understanding of the different aspects of monetary policy can assist in this process. We begin with two most powerful monetary policy makers in the world, the Fed and the ECB, and we explain how they function and the key tools they use to conduct policy. The Federal Reserve is perhaps the most influential policymaker in the world. Financial market professionals follow closely any information related to it and scrutinize every statement or opinion issued by its board members. The Federal Open Market Committee, FOMC, is the main monetary policy setting panel of the Federal Reserve System. It consists of 12 members, including all 7 members of the Board of Governors of the Federal Reserve itself, located in Washington, D.C., the President of the Federal Reserve Bank of New York as a permanent member, and 4 of the remaining 11 district bank presidents, elected for one-year rotations. The Fed chairman also chairs the FOMC. All district bank presidents attend FOMC meetings and participate fully in discussions, even if they have no voting rights in that year. The FOMC releases a policy statement following each meeting or whenever monetary policy changes are made. the FOMC prefers to limit policy changes to regular meetings, especially since rate decisions taken between meetings might appear to convey a high level of anxiety about the economic situation. FOMC statements are among the most powerful movers of financial markets. They usually include details of policy changes plus a brief description of the committee's view of current economic conditions, including the balance of risks between unacceptably high inflation and unacceptably weak growth. Market professionals scrutinize the language of each FOMC statement to discern the principal factors weighing on policy determinations and how these might be changing. They search for indications of any sense of urgency among policymakers and, by extension, of the probable timing and magnitude of further rate adjustments. Three weeks after each FOMC meeting, the minutes are published. These provide a summary of the panel's discussions and the votes taken, as well as a description of the economic and financial conditions prevailing at the time. When there are dissents, the reasons for them are stated in a brief paragraph. Twice a year, the Fed chairman reports to Congress on the conduct of monetary policy, both in written form and in testimony before the oversight committees. As part of this report, the FOMC publishes summary statistics of forecasts submitted by all 19 participants regarding real GDP growth, inflation, and employment. The Fed intervenes further in the market through a number of additional mechanisms. It can manipulate the supply of non-borrowed bank reserves via so-called open market operations, purchasing and selling treasuries and federal agency securities. These operations are conducted via a small group of financial institutions known as primary dealers. The effect of these operations on banks' liquidity depends on three considerations. First, whether the resulting flow of funds is into or out of the banking system. Second, whether these operations have temporary effects, typically when conducted through repos and reverse repos, or permanent impacts, as in the case of outright purchases and sales of securities. And third, the volume of liquidity that must be added or drained from the banking system, and which dictates the total size of the operation. Another intervention tool is the discount rate. Each district bank in the Federal Reserve System makes loans to depository institutions in its district to meet short-term liquidity needs through a facility commonly known as the discount window. The interest rate charged on these loans is known as the discount rate. A third intervention tool introduced by the Fed during the recent liquidity crisis was the term auction facility. Under the TAF, the Fed auctions a predetermined amount of loans to depository institutions that qualify for primary credit at the discount window. The final and probably oldest intervention tool is the so-called reserve requirement, which stipulates some percentage of deposits in each category that depository institutions must set aside as reserves. These reserve requirements can be met either through deposits at Federal Reserve district banks or through cash held in bank vaults. Reserve requirements are intended to provide a liquidity cushion for the banking system. They are also used by the Fed to influence bank lending activity, since an increase in these requirements effectively increases the marginal cost of granting a loan. Monetary policy in the Eurozone is the responsibility of the European Central Bank. The ECB's primary stated objective is the maintenance of price stability, defined as a year-on-year inflation rate not exceeding 2%. This objective dominates others, such as growth and employment, that are typically pursued by the ECB only when consistent with price stability over the medium term. ECB monetary decisions are taken by its governing council, made up of the ECB's executive board and also the governors of each of the national central banks. The governing council meets frequently, but monetary policy is on the agenda only at the first meeting of each month. The main task of the Governing Council is to define the monetary stance by fixing the rate of its refinancing, or refi, operations, a key determinant of short-term rates through which the ECB seeks to affect price levels and ensure its ultimate objective of price stability. Shortly after the monetary policy meeting, the President and Vice President hold a press conference which begins with an introductory statement. This statement provides an official assessment of the economic situation and justifies the main decisions taken. The ECB also publishes a monthly bulletin providing extensive coverage of Eurozone economic developments, including a complete set of economic and monetary data assessed by the ECB. The Governing Council uses macroeconomic projections prepared by ECB staff, especially regarding GDP growth and CPI inflation, as important determinants of its assessment of the Eurozone economic situation. Finally, the ECB intervenes in the market through weekly refinancing operations to provide liquidity to the banking system if needed. The ECB announces its estimates of liquidity needs, and banks bid for different amounts at different rates, floored at the current refi rate. We conclude this chapter with a discussion of how these various indicators affect financial markets and how traders translate new releases into anticipations of price movements in the equity, fixed income, commodity, and foreign exchange markets. We focus in particular on identifying the economic data with the largest impact on asset prices, beginning with a listing of relevant criteria. The first criterion is the data's relevance to economic growth. Reports that receive the greatest attention are those that cover large segments of the economy or that relate to the more volatile components of business activity. The U.S. retail sales figure is a good example, since it provides a reliable indicator of consumer spending, the largest component of U.S. GDP. Home sales and housing starts also have a significant market impact normally, despite the modest share of GDP they represent, principally because activity in this sector is highly cyclical. The second criterion is the timeliness of the information. By way of example, weekly data on initial claims for jobless benefits in the US are released only 5 days after the week to which they apply, prompting the careful attention of market professionals. In contrast, the final report on quarterly GDP lags the end of the period it covers by almost 3 months, giving it less importance in the eyes of market professionals, despite the fact that it covers the single most important economic indicator, namely GDP. The third criterion is the reliability of the data, since some releases are subject to significant revisions after initial issuance, reducing their importance to the market. In addition to these criteria, special attention is generally given to the economic and policy environment. The stage of the business cycle is a critical factor to keep in mind. In the early stages of a business expansion, the economy is able to grow without causing inflationary imbalances, and monetary policy is typically neutral or accommodative. At those times, as well as in recessions, market anxiety about inflation tends to be low, and the focus is on data that provides leading indications of demand and output. Later, when the economy has expanded to the point where capacity is scarce, inflation reports become more important. Policymakers always have an implicit or explicit ranking of matters of concern to them, and perceptions of this ranking appreciably shape the market's sensitivities to specific data. Additionally, over time, the reliability of certain indicators often changes as a result of structural changes in the economy. In addition to the data releases, as mentioned previously, public statements by policymakers can have a big impact on markets. This explains why market participants scrutinize policymaker statements closely to discern possible changes in policy, especially when uncertainty is high. We illustrate the foregoing with examples of large movements in equity and fixed income markets that resulted from economic releases or policymaker statements in recent times. The S&P 500 declined 2.33% on July 26, 2007, following publication of new home sales numbers indicating a large drop of 6.6% in such sales, only 1 day following substantial declines in existing home sales as well. The S&P 500 again declined 2.66% on August 3, 2007, following publication of the employment report showing a weaker than expected payroll report, with the unemployment rate rising 0.1 percentage point to 4.647%. Yet again, the S&P 500 declined 2.35% on August 28 of that year, following publication of FOMC minutes revealing the committee's continuing concerns about inflation, undermining market expectations of an interest rate cut. The following day, the index gained 2.19%, following publication of a solid consumer confidence report. The 2-year Treasury yield declined 13 basis points on August 3rd of that year, following publication of a weak employment report and a weak ISM non-manufacturing survey, decreasing the risks of a rate hike. And finally, the 2-year Treasury yield declined a further 12 basis points on August 15, 2007, despite publication of CPI data showing slightly higher than expected core inflation, due to a continuing flight to quality in money and bond markets. The next day, the notes yield declined an additional 19 basis points after premier mortgage lender Countrywide Financial drew on its $11.5 billion bank credit facility to replenish its liquidity, accelerating the flight to quality in these markets. This completes this chapter 3 and brings us to the quiz.